In this video, let's learn about role of Securities and Exchange Board of India in primary market. The primary market is the market which provides a conduit for sale of new securities. This market provides chance to issues of securities, the government as well as the corporate to raise capital to meet their requirements of investments or liberation of their obligations. SEBI has taken several measures to protect the interest of investors and draw the small investors to the market. Entry and disclosure norms have been tightened to prevent the exploitation of investors by unscrupulous promoters. Share allocation and promoters' contribution are also regulated. Primary market is a market where the securities are directly issued by the companies to their investors. Here, Securities and Exchange Board of India acts as a regulator of both primary and secondary market. This primary market provides a wide opportunity for the companies to raise funds from the public. The Securities and Exchange Board of India has several rules and regulations for providing protections to the investors as well as controlling the activities of this primary market. In this video, let's learn about the different activities or guidelines provided by Securities and Exchange Board of India for controlling the activities of primary market. Entry norms. Securities and Exchange Board of India's guidelines on entry norms for the companies accessing the capital market with the public issue are summarized below. Here, the Securities and Exchange Board of India has provided certain standards which has to be followed by the companies if they want to issue securities in the primary market, and they are as follows. Entry norm 1. The net tangible assets of a company should be at least 3 crore for 3 full years. The physical assets, that is called net tangible assets, these should be at least 3 crore for the past 3 years if they want to issue securities in the primary market. The company should have a track record of dividend payments for a minimum of 3 years preceding the issue. If the company wants to go for IPO this year, they should have a track record of paying dividend in the past 3 years before going for IPO. The net worth of the company should be at least 1 crore in 3 years. Net worth means the difference between the total assets and the liabilities of the company. The net worth, it should be at least 1 crore in the past 3 years. In case of a change in the name, at least 50% of the revenue of the preceding 1 year should come from the new activity. The company can go for changing their name whenever they introduce a new product or introduce a new activity. If they have changed their name in the past year, minimum 50% of their revenue they should have received from the new activity that they have introduced in the past year. It is all about the entry norm 1. Entry norm 2. The issue shall be through book building with at least 50% allotted to qualified institutional buyers. Here, there are several methods the company can follow in order to issue shares in the primary market. Book building is one of the process, and it says the issue shall be through book building process. It is a price discovery process with the help of providing bids to the investors. Here, qualified institutional investors means the financial institutions like mutual funds, insurance companies or banks. Here, the 50% of the book building issue should be given to qualified institutional investors. The minimum post-issue face value of capital should be 10 crore, or there should be a compulsory market making for at least 2 years. The post-issue share capital, face value of the post-issue share capital should be 10 crore, or there should be a compulsory market making. Market making means the process of providing liquidity to the securities of market. Here it is done with the help of market makers. Market makers are the one who buy or sell the securities at the prevailing price in the market. They help the company to get liquidity for their security. Here there should be compulsory market making for at least 2 years in the market. It is entry norm 2. Entry norm 3. The project should be appraised and participated into the extent of 15% by financial institutions, scheduled commercial banks, and of this at least 10% must come from the appraisers. Appraisal means valuation of the project. Here it has to be done by the financial institutions or scheduled commercial banks. They are called appraisers and they have to contribute 10% to these projects. In addition to satisfy the aforesaid eligibility norms, the company should also satisfy the criteria of having at least 1000 prospective allottees in its issue. Apart from the above conditions, the company should also have 1000 prospective allottees. 1000 prospective allottees means the prospective buyers of the company. They should have 1000 prospective buyers if they want to issue securities in the primary market. These are the 3 entry norms. Other than that, there are some other conditions. Promoters contribution. Promoters contribution should not be less than 20% of the issued capital irrespective of the size of the issue. The minimum promoters contribution shall be locked in for 3 years. Here promoters are the one who start the business and their contribution should not be less than 20% of the issued capital of the company, and this contribution will be locked in for a period of 3 years. Disclosure. The draft prospectus filed with Securities and Exchange Board of India is a public document which enhances transparency. It should provide information to the investor such as current position of the company, its future prospectus, and risk factors associated with investing in the company. Here every company has to file their prospectus with the Securities and Exchange Board of India. Prospectus are like invitations which contain all the details regarding the company. These invitations or prospectus are like public documents. They are issued to the public. They should not have any wrong details. And disclosure means transparency or providing complete details to the details about the company to their investors. Book building. Securities and Exchange Board of India has issued guidelines relating to 100% book building in the issue of securities to the public through prospectus. It recommends a 2-tier underwriting system for book built issues. Syndicate members are responsible for the primary underwriting and book runners are take the responsibility in case of their default. I have already said a company can issue securities in several ways. Here book building is allowed to up to 100%. A company can issue all the securities through book building process itself. Here there is a need for underwriters. Underwriters means the one who provide guarantee about the subscription of securities. Here this securities market provides 2-tier underwriting facility for the companies. 2-tier underwriting means syndicate members underwriting the security in case of minimum subscription. In case of failure to reach the minimum subscription level, if they fail to subscribe the securities, that is syndicate members fail to underwrite the securities, the book runners has to underwrite the securities. That is called 2-tier underwriting. First, its syndicate members has to underwrite the securities. In case they cannot underwrite, then the book runners will underwrite the securities. That is called 2-tier underwriting. Allocation of shares. In book build issue, the mandatory allocation of shares is 60% to qualified institutional buyers and 30% to retail individual investors and 10% for non-institutional investors. After the closure of the issue, the bids received are segregated under different categories, namely firm allotment, qualified institutional buyers, non-institutional buyers, and retail investors. For each category, the oversubscription ratios are calculated against the shares reserved for each of the categories. Here, allocation for which they have specific criteria. 60% has to be given to qualified institutional investors, 30% to retail individual investors, and 10% to the non-institutional investors. Qualified institutional investors are the financial institutions such as mutual funds, UTI, then insurance companies, financial institutions such as banks, etc. This retail individual investors includes individuals who are willing to invest up to 2 lakh rupees. Then non-individual investors includes the individuals and the companies who are willing to invest above 2 lakh rupees. There is a limit and it has to be fixed by the stock exchange itself. Market intermediaries. Licensing of merchant bankers or authorization by SEBI was the first step taken to regulate the intermediaries. This licensing of merchant bankers is based on capital adequacy as well as track record of capital market related activities. In the course of time, the financial intermediaries such as underwriters, registrars or transfer agents came to be licensed. Securities and Exchange Board of India has a right to inspect the records of any intermediaries. In the stock market, we can find several intermediaries such as broker, agents, merchant bankers, registrars, etc. These registrars or other intermediaries, they have to register themselves with Securities and Exchange Board of India. They have to get the license from Securities and Exchange Board of India. This measure is taken by the SEBI mainly for regulating the activities of these intermediaries. This Securities and Exchange Board of India has a right to conduct the audit of the books of accounts of these intermediaries on a regular basis. These are all about the role which is played by Securities and Exchange Board of India in primary market, that is 3 entry norms, promoters contribution related regulation, disclosure, book building, allocation of shares, market intermediaries. That is all about role of SEBI in primary market. Thank you.